Welcome to our deep dive into NVR, a company that has fundamentally redefined the home building industry. While most competitors operate as heavy asset owners, NVR has carved out a unique niche by prioritizing capital efficiency over land speculation. Founded in 1980 and headquartered in Reston, Virginia, NVR operates under major brands like Ryan Homes and NV Homes. Today, we will explore why this company is often cited by value investors as one of the most disciplined capital allocators in the S&P 500. We'll look at their specific business model, which minimizes risk by avoiding traditional land ownership, and examine how this strategy translates into industry-leading returns on equity. Whether you are a portfolio manager or a strategic analyst, understanding NVR's asset-light approach is essential for any modern financial perspective on the housing market. The core of NVR's success lies in its asset-light strategy. Unlike traditional home builders who purchase large tracts of land years before a single home is built, NVR utilizes lot purchase agreements, or LPAs. This means they typically only put down a 10% deposit to secure the right to buy land. This allows NVR to avoid the massive balance sheet risks associated with holding raw land through economic cycles. If the market turns, NVR's maximum exposure is generally limited to that deposit, rather than being stuck with billions in depreciating real estate. This strategy ensures that their capital is not tied up in non-productive assets, allowing for much higher velocity in their operations compared to peers like Lennar or D.R. Horton. Because NVR doesn't own the land until they are ready to build, their financial metrics are often staggering. For over a decade, NVR has consistently achieved a return on equity, or ROE, that exceeds 40%, far outperforming the industry average. This efficiency comes from their lean operations and high inventory turnover. By focusing on just-in-time inventory for land, they can reinvest their profits much more effectively. In this slide, we see the correlation between their low asset base and high margin returns. For decision makers, this represents a lower risk profile with a higher upside potential during market expansions and a significantly safer floor during contractions. Their disciplined approach to overhead and marketing also contributes to these industry-leading figures. NVR operates through three primary brands, each targeting a specific segment of the market. Ryan Homes is their volume leader, catering primarily to first-time and first move-up buyers. NV Homes targets the luxury and move-up segment with higher architectural standards and premium finishes. Finally, Heartland Homes serves the custom tier market. This multi-brand strategy allows NVR to capture market share across various price points while utilizing the same efficient back-end logistics. By dominating the Mid-Atlantic region, specifically markets like Washington, D.C., Baltimore, and Philadelphia, NVR achieves economies of scale in materials procurement and local labor management that smaller local builders simply cannot match. One of the strongest proofs of NVR's business model is its performance during the 2008 financial crisis. While many of the nation's largest home builders faced bankruptcy or massive losses, NVR remained profitable every single year of the Great Recession. Because they didn't have billions of dollars in land assets that were rapidly losing value, they didn't have to take the massive impairments that crushed their competitors. This resilience is a key factor for long-term investors. It proves that the asset-light model isn't just a bull market strategy. It's a defensive fortress during the worst possible economic conditions. This history of stability provides a unique level of confidence in the management's risk mitigation framework. What does NVR do with all the excess cash generated by its efficient model? They buy back their own stock, and they do it aggressively. Over the last 2 decades, NVR has reduced its shares outstanding by more than 75%. This share cannibalization strategy dramatically increases the earnings per share for remaining stockholders. Instead of expanding into risky new territories or overpaying for acquisitions, management chooses to return value to shareholders by shrinking the equity base. This consistent demand for their own shares provides a powerful tailwind for the stock price. For business professionals, this signifies a management team that is deeply aligned with shareholder interests and skeptical of empire building at the expense of returns. NVR's efficiency isn't just about financial engineering, it's also about operational excellence. They operate their own lumber yards and component manufacturing facilities.
This vertical integration allows them to build homes faster and with more consistent quality than builders who rely entirely on third-party suppliers. By prefabricating walls and roof trusses in a controlled environment, NVR reduces on-site waste and labor hours. This NVR building system is a cornerstone of their ability to maintain high margins. Furthermore, they provide mortgage, settlement, and title services through NVR Mortgage, creating a one-stop shop for buyers and capturing additional margin from every home sale without increasing the inventory risk.
To truly appreciate NVR, we must compare it to its peers. While Lennar and D.R. Horton are significantly larger in terms of total homes delivered, NVR consistently beats them on nearly every efficiency metric. NVR's debt-to-capital ratio is often lower, and its interest coverage ratio is significantly higher. The market rewards this efficiency with a premium valuation. When you look at the inventory turnover, how quickly a company sells and replaces its stock, NVR leads the pack. This is the difference between a high-volume land speculator and a high-efficiency home manufacturer. For a decision maker, NVR represents a quality play in a sector traditionally known for cyclical volatility and high leverage.
No investment is without risk, and NVR is still tied to the broader housing market. Rising interest rates are the primary headwind, as they decrease home affordability for the typical Ryan Homes buyer. Furthermore, because NVR relies on land developers to prepare lots, a shortage of finished lots can slow their growth. They don't control the raw land phase, which means they are dependent on the health of their developer partners. However, their asset-light model provides a cushion that others don't have. If mortgage rates spike and demand drops, NVR can simply walk away from their lot options, losing only their deposit, while competitors are forced to write down the value of the land they own outright.
In conclusion, NVR is more than just a home builder. It is a sophisticated capital allocation machine. By sticking to its asset-light strategy, the company has avoided the pitfalls of its industry while delivering exceptional returns to shareholders. Its focus on the Mid-Atlantic region, vertical integration through prefabrication, and relentless share buybacks create a compounding effect that is rare in the stock market. For strategic investors, NVR demonstrates that how you structure your business is just as important as the product you sell. As we look to the future, NVR's ability to navigate volatile cycles makes it a benchmark for operational excellence. Thank you for joining this deep dive into one of the most efficient players in the American economy.